Today, folks, we need to talk about SCHD. On the face-ripping rally the S&P 500's gone on over the last year, it makes the total returns of SCHD absolutely abysmal. And as a total return-oriented investor, we need to talk about this holding in my portfolio because as a Canadian, I've been buying this in my RRSP to try and avoid the withholding because as a Canadian buying over-the-border stocks, the government says, hey, if you're going to bring money across the border, we're going to charge you 15%. But for some reason, if you put it in this tax sheltered account, we'll waive that 15%, allowing me to reinvest the dividends, get some compounded growth without having any tax implications until I pull the money out at a later date, because that's how this account generally operates. And I've only seen a measly 9.49% return from a capital standpoint over the last year or two that I've held this ETF. I'm lucky to get about a 4.26% yield though, but it doesn't mean much when I look at the total returns of my other holdings. And I want to talk about the strategy I have with this ETF, my plans on if I'm going to sell it, am I going to buy more, how do I feel about it moving forward. So if you're on a path to financial independence, if you damn well one day want to retire early, join me on that journey by simply hitting that subscribe button because against my other, dividend ETF, VDY, for those Canadians out there that love monthly income, I love my VDY dividend ETF, and it absolutely destroyed SCHD this year. I mean, even if you include the fact that the Canadian dollar dropped by 7.5%, and you took that against the gains of VDY, we still outperformed with that ETF, which I think is just absolutely hilarious, but I think it's on the back of interest rates. I had a prediction, my bet with SCHD was as they begin to cut the interest rates that these dividends or these value-oriented stocks, because most value stocks pay higher yields, these stocks have a lot of debt typically, right? Like they have higher debt to asset ratios. They're paying a lot more in interest expense than some of the large tech companies are. So I presumed as interest rates came down, that would start affecting their cash flows, increasing them, not having to pay as much on their debt. And obviously the Federal Reserve went, yeah, forget that idea. We're not going to cut interest rates as aggressively as we thought we were. So then we saw a massive decline in this ETF, whereas in Canada, they've still been cutting interest rates much more aggressively, easing the Canadian economy, right? So taking a look at the strategy though, that wasn't my actual reason for buying it. My actual reason for buying this ETF was to upper weight the lower half S&P 500 companies to equalize some of the performance while we hand select some tech companies. It's kind of the wife and I strategy. We're trying to just inch up a little bit higher of a yield in the overall portfolio and then try to get extended returns from a few hand-selected stocks, right? And I honestly believe there's no real reason at this point to be buying a lot of growth ETFs because they all kind of overlap at this point with the S&P 500. I've honestly come to believe the S&P 500 is a full-weighted growth ETF because over time what's happened is the tech companies have garnered such massive market caps, they now make up a massive total position of this portfolio or the ETF that I buy, VOO, right? Because if you look right now, Apple, Nvidia, Microsoft, all of these make up 6 to 7 percentage weighted points in the ETF. Whereas if we look at something like the QQQ ETF, for example, you got Apple, Nvidia, Microsoft. Yeah, I mean, it's not exactly 7%, but it's friggin' close, right? With Apple at 9.7. And the problem is when I look at the Qs right now, I'm not that excited about these. I don't like Apple currently at its values, and it's crashing today. It's come down quite a little bit. I don't like Nvidia that much. I really don't like Tesla that much at these values. But you know what I do like? I do like Google. I do like Meta. I like these positions, so I feel better off cost averaging into the S&P. Again, upper weighting some dividend income. So when the market lacklusters in performance like it did through 2022, I have extended cash flow to reinvest. But then again, when these stocks we hope outperform, will boost the portfolio's overall performance, hopefully giving us some outsized gains. But again, this is just a weird strategy. It's just what we've ended up implementing over the last couple years. And I really think that if you look at the 5-year performance of the QQQs, we're not going to see the same past performance into the future. And again, I'm speculating here, but if you go back 5 years ago and you looked at the weightings in these two ETFs, they were dramatically different. Whereas if you look at the last 1 year, you'll see the performance is very in line because I really think that once interest rates continue to get cut, you're going to see the lower half of the market still continue to do well. But even if tech continues to outperform, it's so upper weighted that you see such equal performance between these two ETFs. But the Qs come with much more volatility, right? Again, these are just my opinions. I could be horribly wrong about this, but let's break down SCHD and just generally what I think about it and if I'm buying more or my thoughts on it so far. Because this 6% return over the last year, guys, is just, it was so great leading up, right? It was so great. We saw 15%. You clap on that 4% yield. Oh my God, we almost saw a 20% return. It looked like it was going to keep up with the S&P like it had in in the past. I mean, in its history, it did a really good job at even outpacing the S&P at one point, but since these interest rate cycles have come around, it really detrimented the returns here, right? But if we take a look at the holdings, and I want to break this down because the current starting yield, I think, is around 3.8%. We all know this ETF has an extremely low expense ratio. It's a passive-oriented Dow 100 focused dividend ETF, but it has reconstituted a lot of the stocks. In fact, a lot of the interest rate recovery plays that I was banking on have actually been de-weighted a bit. Things like Home Depot, they're still in here, keep that in mind, but they have been de-weighted in favor of other companies like Pfizer and AbbVie, more healthcare-oriented stocks. And if we just kind of break this down with the top 5 holdings in here, being Pfizer, AbbVie, Coca-Cola, Cisco, BlackRock, we can see that we should see much equal weighted performance because, I mean, BlackRock's up 27%, Pfizer's down 10%, but we see a lot of green. Keep in mind, a lot of these stocks have shifted throughout the year, right? So we're not seeing that beginning year performance. But what's really been hindering the overall performance of this ETF is not actually the top weighted holdings. It's more the lower weighted holdings. And we're going to talk about those in a moment. But let's just take a look at the top 5 here, right? Just to see where we're going into the future from an analyst expectation standpoint. Pfizer, I know, is a favorite amongst a lot of dividend investors out there right now. And it is well below its analyst price expectations, sitting at around $26. Low end price target was 25 and the high is 45. I really feel like a lot of these stocks have been, price follows performance, essentially, right? Like if a stock underperforms, people hate on it. It's a terrible buying opportunity. Don't buy it. If the stock is skyrocketing like your Teslas and your Palantir, oh my God, it's the best thing you could ever buy. That tends to how stocks, get pulled ahead in value and they get what we call bubbly or overbought. Whereas a lot of people are considering these stocks to be oversold. So you got AbbVie in here. Again, trading well, in the lower part of its price targets. Coca-Cola is well below the lowest analyst price target of $64. You look at Cisco Systems here is kind of right in the middle of the average price estimates. And you got BlackRock that is also trading quite a bit below, some of the average analyst price expectations. But these stocks, I think, they're stellar. I think going forward, if you're buying them today, I don't think they're the worst decisions you can make, but the stocks that I would buy on my own and the stocks that I love in this ETF are things like Pepsi. I was thinking the other day, I'm like, is it worth me buying some Pepsi on an individual basis, or Hershey, or some of these companies that I love? And then I'm always reminded that SCHD owns all of these and a lot of other good stocks I probably wouldn't look at otherwise. But Pepsi has just been absolutely decimated this year. These are the stocks that have really weighed the performance of SCHD, and I'd argue that they are incredible buying opportunities that are paying out wicked high yields that are well above their historic averages, right? When you look at the revenue of Pepsi, it hasn't really gone anywhere, but we know that, Pepsi's price competition in this, inflationary environment really stalled them out a lot because they've been seeing lower volumes as people choose, off-brand products that aren't nearly as expensive, but we all use Pepsi products to some extent. I'm sure if you've looked into the company. You think of things like Verizon, right? I thought Verizon would be one of the best interest rate recovery plays, but again, as the Fed kind of wiped us out toward the end of the year here, it really led to lackluster returns in the overall SCHD portfolio. But again, Verizon's, revenues haven't really changed that much. But I'm sure, again, as we look at net income, the net income is still a bit abysmal here, right? Like I said, these infrastructure-oriented companies have just been, really detrimented by the higher interest payments they've all been making. Lockheed Martin, how in the last year, on the back of all these geopolitical events, is a company like this trading at a 17 times multiple and has only been up 6% this year, now 5.97% over the last year? It's crazy to me, right? So a lot of these companies that offer that big oomph have now really kind of taken back all of those gains. And I think we're going to see something very similar in tech companies, but these companies are already favorably valued. This is why people keep calling them value stocks, though again, I don't ever consider them value stocks because technically a tech company can still be a value stock if it has exceptional growth ahead of it. I think every stock you're buying should technically be a value stock if you believe in the future of the company, right? But I mean, look at Lockheed. It's been growing revenue quite nicely here, actually. It's been very consistent, especially into the latter half of 2024, right? So I think there's still some huge potential. And my thoughts with the overall ETF and my plans are, I am not buying it as aggressively as I was because right now, unfortunately, SCHD makes up, I think, somewhere around 27% of my entire portfolio from my half, not including my wife's. And I don't like that percentage weighting, considering how limited we are invested in VDY. even though, the S&P makes up over 50% of our portfolio, we're 80% weighted ETFs. I really want an equal weighted balance typically between VDY and SCHD because I still believe in the future of these ETFs. I have no plans on selling them. I'm still going to reinvest the dividends going forward. Again, you got to recognize, guys, that these are really underappreciated companies that can still do very well as they cut interest rates. But again, I'm still trying to just keep cost averaging into our three primary ETFs, VOO, VDY, SCHD. And then the primary goal is to keep hand selecting some of those stocks like Google, companies that I love like Aduro, Facebook. There's so many great companies out there, and we're just trying to core concentrate those a bit as well. So I'm very excited to see what the total performance is going to look like. As I told you guys, we're going to track my total returns from the start of the year into the latter half of the year to see if we can beat the S&P 500 with this specific strategy, because let's be real, the way we have things weighted right now, our total, I think, dividend yield is like 2.5% or something like that. It's still very small for what most people like, but again, I'm trying to be a total return investor. I just want a little bit more yield and, just try and get some growth out of things I truly believe in. And I'd love to know what you're doing, what you think about SCHD, and your thoughts generally in that comment section below.